Today is September 4th, 2020. The S&P 500 is up 409 times over the last 100 years. Okay, up 409 times since the last 100 years. If you take into account dividends, okay, the S&P over the last 100 years is actually up over 20,000 times in the last 100 years. So basically what's been happening currently, especially in options derivative markets, is major out the money calls in like mega cap tech names, Tesla and Microsoft and Apple and Nvidia. Those names are trading with extra activity. So, the big banks, these institutions, they are getting gamma short. Okay, gamma short they are. We saw it, right? We indicated 2 days ago, two trading sessions ago, that we saw profit taking, right, in the Nasdaq and the S&P and even the Dow. So obviously, people were taking profits at these ridiculous valuations, at these ridiculous PEs. It was obviously expected. It was just a matter of time, and obviously. Europe markets are flat. European indexes are flat right now, and U.S. indexes are kind of rallying to the downside, especially the Nasdaq. The Nasdaq's implied openings is down 5%. Okay, so people are clearly unwinding. A lot of these holders are individual retail investors that, like I said, are profit taking. So, the 15-year mortgage rate fell to its new low of 2.42%. And, and just in relation and all relativity, how this is systematically related is the fact that Denmark's largest bank, or I think it might have been their third largest bank, is offering a 10-year mortgage at 0.5%. 0.5%. A 10-year mortgage at 0.5%. Can you imagine that? So this is systematically related, as virtually any country that has access to QE programs and credit facilities and dollar swap lines, they have therefore the ability to perform QE in one way or another that will inflate their overall supply of money and credit, and therefore that'll raise both consumer and asset prices. Typically, just like the US, it typically performs first in asset prices, like in the stock market, for example, and then consumer prices comes in with inflation, and eventually possibly hyperinflation, like with Zimbabwe or Argentina, and like I said the other day, Australia in just 30 years is in a recession. It's been 30 years. So things are taking place globally, obviously. And just another fact is the fact that U.S. executives, in just this last month alone, since 2015, they've sold almost $10 billion worth of their own stock. Okay, so U.S. executives, and I think the stat was containing over 1,000 of these executives, whether they're CFOs, CEOs, directors, whatever, $10 billion worth of their own stock they sold in this past month, and that's the highest rate that we've seen since, I think, February of 2015. So that is unbelievable. And also the fact that the Fed's total assets are now over $7 trillion, which is 36% of GDP, I think. And I know the ECB's is around 60% of GDP. And I know for certain the Bank of Japan's is the highest relative to GDP of 135%. Okay. Monetary policy gone wild. Consumer confidence, it's at its lowest point since 2008 of May. All right. Consumer confidence is at its lowest point. Shouldn't be too much of a surprise. Nobody's confident. Nobody's even confident to leave their own homes. you know, so you know, and you know, it's not even that. You know, the fact that we're facing a variety of debt crises in one, ranging from sovereignty crisis, sovereign debt crisis, to you know, liquidity crisis, to a dollar crisis. Uh, you know, it's just unbelievable. It's horrifying. And you know, China is selling 20%. According to an article I read actually this morning, they're apparently selling 20% of their treasury holdings, which was initially $1 trillion, okay, entirely in US treasuries. You know, and they're cutting that to about $800 billion. So they're cutting 20% of their entire US Treasury securities supply of their holdings. 20%. I mean, that's a pretty crazy signal. That's a pretty crazy signal also. So there's signals left and right every single day, like I said. So let's kind of get down to the, I just thought I would share my Thinkorswim just for a second, even though I'm not trading today, but I think it's necessary for you guys to see here. Obviously PRPO, you know, shorts are covering under 2. Shouldn't be much of a surprise. I'm actually expecting that. I've been expecting that. I've been waiting for it. So now I'm waiting for testing numbers to come out. I'm waiting for, you know, the in-house care for their, you know, their 15-minute treatment, their very frugal treatment that works like a charm. They make 1 million of them a day. So we're in a great position here. So I'm just simply accumulating more and more. So I'm very, very happy that I get even lower prices here. Anyways, I was checking out DPW. It's getting some hype this pre-market. Obviously, just off the bat, this is obviously right now forming a upper wedge. So let's draw that for you guys here. Upper wedge. Right, so that is an upper wedge. And so it's going to test 240. It's probably going to have some resistance around there. And I'm forming a doji, so we might probably test, if not the moving averages here, we'll test this, you know, this ascending support. I like to refer to the 5-minute better just because it's a better macro picture of the intraday chart. You see, we're making higher lows. That confirms the upper wedge formation. The fact that we're converging the ascending support and the diverging resistance in a upward slope. Obviously, the MACD histogram is inversely scaled to the stock price. So that's telling us this could potentially break down right here, which is the theoretical result of an upper wedge pattern. Or it could squeeze to the upside. We don't know exactly, but that's what our theoretical, we have to confirm our theoretical results against what reality tells us, right? We have to do that. So we'll wait and see what happens. If it decides to go under VWAP on the 5-minute, that's a pretty good big confirmation, and it closes under, that's a pretty big confirmation that it will continuate further to the downside. But this thing has pretty good firepower so far, pretty good volume, although it shows that it's kind of drying up a bit here. It could be a short-term, you know, kind of pullback. So we'll see what happens. I also saw that KCAC is trending from yesterday. Geez, it's up from 15 to 23. So I don't know. DPW is more. I think there's more arbitrage opportunity in DPW right now, just considering its range in this little of time. But anyways, that's a little bit of a sneak peek. Obviously, this morning at 8:30 a.m., we have our August jobs data. You know, so that's going to be a very, the expectations for it is pretty interesting. You know, I mean, we're expecting some pretty good numbers apparently. We're expecting, you know, sub 10s for, you know, we're expecting quite a few great things. So I don't know. I think it's probably definitely because these are not real jobs that are new jobs. These are just jobs that have been, jobs before, but got rehired again because stimulus expired. So there's nothing left for these people to do but go back to work. Right? They're not collecting claims anymore, or benefits, because they either expired or they don't have them anymore, or because Congress is too stubborn on whether to decide or not to give these people money or not, free money. Although it's fake money, it's free money, so you might as well spend it on what you want. So it's it's kind of a massacre out there. So let's I wanted to show you quickly this Excel sheet. Hopefully I can share it real quick here. Yeah, let's share this screen. So here you're looking at, we're going to look at a couple numbers here. And basically this is the Fed's transactions for a variety of different kinds of securities, ranging from TIPS to GESs to corporate debts, all these different things, MBSs. So I wanted to make out a point here: the fact that the Fed is influxing so much cash into their balance sheet, and their balance sheet has risen $4 trillion in just less than 6 months. So it's $3-4 trillion deficit we're running, and we're running a $27 trillion U.S. national deficit. National debt position, while having all of these other countries like China, India, emerging markets, all these countries holding dollars in the form of treasury securities, and yet they are cutting that position, just like we talked about with China. They're cutting 20% of their treasury position because they understand that there is serious risk in the world's reserve currency status of the US dollar. And not only that, but they also understand that the Fed is they're relentless. They're acting out of, the Fed even said this, Powell even said this, they're going to act and they're going to provide all the firepower they possibly can, because there's nothing left for them to do, because they already shot the wound. The wound is already there, and all they can do is, basically the Fed, they were the bartenders and fed Wall Street all this alcohol, and Wall Street drank the alcohol, and then they were all drunk and screwed up everybody's orders, and everybody went broke. Well, that's exactly what happened, but it never would have happened if the Fed did not give them the alcohol. If they never received the alcohol from the Fed. And the Fed enabled this because they believe monetary and fiscal policies are what control this economy. But on the controversy, the free market should, but it doesn't, unfortunately. But it should, and it used to, and it was monetized based off of this real medium of exchange of gold. And well, we're not going to get into that at this video. But you see with primary dealers, international dealer brokers, relative to last week, I'm just talking about just in terms of a week duration. Just look with U.S. floating rate notes. We're kind of, the Fed's trying to, if you look at these down and up, it's kind of all over the place, especially with the MBSs are huge because that's what the Fed buys the most, other than treasury securities themselves, throughout the entire curve. But MBSs are huge. They buy a lot of them, and commercial banks do too. They offer it in a form of collateral, and then the government too, and then the Fed buys it from the government. So the international dealer brokers from last week, it was a change of minus 21. I think this is in millions. Yeah, 21 million. Right, for a change from last week, and a change from minus 86 with other kind of MBS related securities, ranging a total of minus 107 million. So that brings us down to 284. Another important one was, what was it? Government security. Well, we already know. I'm just trying to find, okay, right. So, when the Treasury buys these securities, in the case of TIPS, Treasury and inflation protected securities, they have maturities. So the government has to unwind unless they want to roll over, their TIPS into a longer maturity, but they're facing duration risk then. All right, they're facing duration risk with fake money that's completely devalued money because it's freshly printed money. So it's not, it's not produced through the economy. It's produced through a printing press, and so the productivity of these dollars is far, far less than the productivity would from the free market. Just in a blunt way of saying it. But these coupons are basically what the investor gets, and we see that. And if we look at what's due in 7 to 11 years, that's at a negative almost 20 million position. So these transactions are facing negative territory because governments are kind of mixed between what to buy and what to sell. They don't really know what to do. They don't know what to do. I mean, cash transaction. I mean, oh my God, it just hurts to look at these numbers. It really hurts to look at these numbers. We know that they've been buying corporate debt. Look how far out of maturities they're buying. Such long-term maturities in all of this debt that I mean, what are they thinking? This is just money put into garbage. They're the ones that make this high risk yield become essentially a low risk yield. If you just look at the 30-year, we're ranging at like 1.35. So anyways, you get the point. You just by looking at the numbers, it's pretty self-explanatory. But anyways, I think I wanted to show you just one more thing. No, I actually didn't. But you heard it here, folks. It's pretty self-explanatory just, again, by looking at these numbers. And you could already tell by these numbers what the Fed is trying to get out of this. Like they said, we know that they want higher inflation. They want inflation to ride as high as it goes because they know it already took place in asset prices in the stock market for the last 4 years. We never recovered from 01 and certainly not 08. So the question is from here on out, how many billions and billions of dollars a day does the federal government want to spend in order to, obviously in reality, exacerbate the problem of debt monetization while destroying the wealth gap, while widening the wealth gap alongside with credit spreads, obviously. Everything's linked to it. So watch out, watch out. But of course, don't fight the Fed. Never want to fight the Fed because they're too big, they're too powerful. They have all the money in the world because they make the money, they print it. And, it makes you think, why not just print out the entire U.S. national debt position, which is $27 trillion almost, and just print it all? What's the difference? But they know that doesn't work because inflation will be even higher than Zimbabwe's by then. So we have a lot to talk about. There's a lot to talk about. So I'm happy to end this here, folks. Again, we are not financial advisors. We do not provide financial advice. We do not provide anything related to financial advice or anything like that. We do not tell you what to invest into. Anything we say or is only for entertainment purposes only, and you must trade at your own risk. You must do your own due diligence. You must do your research, and it's great to be here with you guys. And Please drop the like button below, hit the subscribe button, and I'll see you soon. Thank you.